Please note, this session is closed to the press. The views and strategies described herein may not be suitable for all clients and are subject to investment risks. Certain opinions, estimates, investment strategies, and views expressed in this document constitute our judgment based on current market conditions and are subject to change without notice. This material should not be regarded as research or as a J.P. Morgan research report. The information contained herein should not be relied upon in isolation for the purpose of making an investment decision. More complete information is available, including product profiles, which discuss risks, benefits, liquidity, and other matters of interest. For more information on any of the investment ideas and products illustrated herein, please contact your J.P. Morgan representative. Investing involves market risk, including possible loss of principal, and there is no guarantee that investment objectives will be achieved. Past performance is not a guarantee of future results. This discussion is for informational purposes only. The speaker's opinions belong to them and may differ from opinions of J.P. Morgan Securities LLC and its affiliates. Views presented on this webcast are those of the speakers. They are as of June 17, 2025, and they may not materialize. This is not an investment research call and is not personal investment advice or solicitation or recommendation. Investment products are not bank deposit products, which means they are not guaranteed by a bank, not FDIC insured, and have risks, like the possibility of losing money on your investment. J.P. Morgan Chase & Company and its affiliates do not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only and is not intended to provide and should not be relied on for tax, legal, or accounting advice. You should consult your personal tax, legal, and accounting advisors for advice before engaging in any transaction. Asset allocation/diversification does not guarantee a profit or protect against a loss. The webcast may now begin.
Hello, my name is Elise Ossenbaugh, and I lead investment strategy for J.P. Morgan Wealth Management. I am very excited to welcome you to our webcast focused on navigating market opportunities in uncertain times. Now, we're going to spend the first time of our call discussing various macro and market themes and how those are translating into the various opportunities that we see across the investments landscape. We're going to be having that conversation with equity strategist Abby Yoder, who I have the privilege of learning from and working with every single day as we develop our investment views. Of course, those investment views only get us so far unless we're also exploring the ways that we can put them into action for the sake of growing wealth and pursuing long-term financial goals. Especially if you are managing some or all of your investments on our own, our hope is that you're going to be able to take the insights we walk through today and pair them with some of the tools that we have within the Chase mobile app and on chase.com to help you become a more confident investor. Lucky for us, we're also joined by Andrea Finan, who leads our self-directed investing platform. And what she's going to do later on in the call is showcase some of those tools, which I am so excited for you to do because I have used them firsthand and have come to understand just how cool and helpful they really can be. So thank you both for joining us.
Thanks for having us.
Awesome. So last thing I want to just kind of go through before we dive into our content today is that we are going to be doing a live Q&A session at the end. We are thrilled to have the opportunity to engage with you, so please submit your questions along the way, and we will do our best to answer every single one that comes in, time permitting. We'll see, though. All right, so Abby, I want to start off this conversation with you and first anchor us in the journey that we've been on as investors throughout the course of 2025. I think if there is one theme that sort of defined the environment for investors this year, it's uncertainty. And so we titled our mid-year outlook Comfortably Uncomfortable, because that, frankly, is the mindset that we think investors have to get in. Whether we're thinking through the uncertainties related to things like trade policy and the introduction of these new tariffs, or fiscal policy here in the United States as Congress works through the tax bill, or most recently, the geopolitical conflict that's escalated in the Middle East, there's been a lot for investors to grapple with. Just as a starting point, I do want to spend some time addressing what's going on in the Middle East right now. I think especially in times like these, it's really important to remember that as investors and as strategists, our role is to try to segment our emotion and really think through what the transmission mechanisms to the economy and markets are actually going to be. So the way that I'm seeing it, it does seem like that transmission channel is likely to be through commodities, namely higher energy and oil prices. You have seen the price of oil rise close to 10% over the past few trading days. And ultimately, that could lead to a feed through to US consumer inflation. But it's important to acknowledge that, especially relative to like the 1970s, the last time we saw such a conflict escalation, or one comparable to this one, that the economy was much more energy dependent and consumers were spending a much greater share of their wallet on those sort of energy products. Second thing, I think, is the historical lesson that we can draw from market analysis, which actually shows that while these kinds of events can generate near-term volatility, they don't tend to have a lasting impact or way that they really inform broad market returns. Just want to pause there and see like what you're observing in terms of market moves and anything that you might add before we dig into kind of the bigger picture exploration of the view.
Yeah, well, I think you're hitting it spot on, right? I think we talked about this morning, right? Geopolitical events like this are something you invest through, not invest for, right? Mm-hmm. So you really think about constructing your portfolio, across different asset classes in terms of thinking about that potential volatility from things like this. But to your point, on the commodity front, what you've seen in terms of equity price action is energy, for example, is the only sector up today when the rest of the market is down. And obviously, we had a very big move last week, north of 14% for the energy sector in response to this. But what you're also seeing is a response in terms of the defense contractor names, mm-hmm. right? So those were up between 2 to 3% on Friday as well. And so when we're thinking about it, we don't really want to hone in on maybe just a couple of days, because I think to your point, this doesn't have the same economic ramifications as even the Russia-Ukraine war back in 2022, right, when you saw oil prices spike to $125. We're still at $75. They're still down year over year. So from an inflation economic standpoint, we still feel comfortable. So we want to focus on the fundamentals. And even though you've seen this rebound in energy, we're still a little bit more sanguine on it, which I think we'll get into a little bit later, but do really still like thematically those defense names that we've seen do well.
Yeah, and I'm glad that you brought up sort of the parallel between Russia's invasion of Ukraine a few years back, because while I know the words "this time is different" are some of the most dangerous ones to utter when it comes to investments, the situation is a little bit different. I mean, if we just isolate Iranian oil production, that represents about like 3% of the global total. Russia, meanwhile, represented a much larger share, about 3 times as great. And also you had developed world economies, like Europe in particular, much more heavily reliant on that Russian oil supply than those developed market economies are on Iranian oil supply. So maybe that's a good segue into kind of starting with the global view. Thinking across the major regions that we monitor within those like developed economy sort of opportunity sets, I would love for you to just start off by sharing your high-level thoughts on where you see the US stock market, the European stock market, and maybe the Japanese stock market headed. I know that's a lot to kind of chew on, so I'll interject throughout.
Yeah, absolutely. And they're all kind of in different places, right?
Yes.
So I think when we think about coming into the year, right, because it's important to level set, because it's all about expectations and where things are falling relative to those initial expectations. And coming into the year, there was this general consensus for U.S. exceptionalism and the U.S. to outperform, given a lot of like policy tailwinds coming from the new administration. And that quickly changed when I think, tariffs started coming into the conversation more meaningfully. However, it's important to take a step back, and I'm sure you've thought about this from an economic standpoint as well. We were in a really strong place, right? Yes. Like we were growing above trend growth economically in the U.S. for 2+ years. The same is true in terms of company fundamentals, in terms of earnings, and we really saw that in 1Q, where we had 1Q earnings originally were expected to grow 7%. They came in 12% year over year. So really, really substantial beat. A lot of that was driven by AI and tech-related companies. But it was also really broad-based. And I think what was really interesting when we're thinking about the large cap companies in the U.S., what we heard from them was like really them trying to strategize and think about what are the different levers that we can pull to really navigate this very uncertain environment, so getting comfortable with being uncomfortable. And you really have to give them credit. Like the past 5-7 years have been incredibly difficult since the initial, trade war, COVID, all these supply chain disruptions. So it's really been, incredible to see how strong they are and to think about how the strong starting point that we're in from a U.S. fundamental standpoint.
Totally. And I think that's kind of been the bastion of stability that's given us the resilience of the backdrop. And even as we monitor the likely headwinds that are emanating from things like tariffs, you have kind of drawn a line in the sand. And your team has come out and said that we think by this time next year, it is entirely feasible to see the U.S. stock market back at all-time highs. And I mean, even today, we're still pretty close, just a few percentage points away. I'd love to turn to those international opportunity sets, because you did mention that, maybe they're in a different starting point from the U.S., but I think they also each have their own domestic stories starting to emerge. So let's go there.
Well, I think that's a great point, right? Like, and Europe in particular, let's think about the past couple of years where, investors have, gotten a little bit more excited about Europe to start the year, only to be really disappointed because growth in China faltered or something happened in the U.S. that really affected the European market. So it was really reliant on these two other geographies. But to your point, particularly emanating from Germany, we have this new positive fiscal impulse, right? Infrastructure spend, defense spend, 12% of GDP, for example. Or if you think about relative to the IIJA, the Infrastructure Investment Act in the United States a couple of years ago, that was 2% of GDP.
Right.
So massive difference. So I think so when we're thinking about it, you finally have this domestic story in terms of fiscal spending in Europe that's very different from prior years. And what that is leading us to believe is that over the next couple of years, it's been all about tech and AI in the U.S., and you've seen much higher earnings growth. You could see that differential in earnings growth between Europe and the U.S. start to close. The U.S. still growing faster, but the difference shrinking, right? And so that garners a higher multiple in terms of Europe. So it really seems to have legs in our view instead of just a one-off.
Well, and I think it's a valuable thing to draw out as well, because while, of course, the U.S. stock market does represent about 70% of that MSCI World benchmark that we tend to use as our starting point, a lot of investors have been overweight the U.S. And even beyond this sort of near-term story related to the fiscal spend coming out of Germany, there are other reasons that I think from a structural perspective, it makes sense to consider allocating to Europe. I mean, you've got some of the highest dividend yields in the world. You have the diversification benefit that you're getting, given that it's not as heavily weighted to sectors like tech as you get in the United States. Anything to add on Japan, just to kind of round out this conversation?
So similarly, and you're thinking, you have to keep in mind the currency exposure. To your point, really great portfolio diversifiers in this environment, given our view on where the U.S. dollar goes from here, weaker. Japan is kind of like in a totally different environment in that they're finally, over the past 30, 40 years, entering this period of reflation, right? They have a shrinking labor force, so they've got positive wage growth. Corporates are earning money, which means they don't want to hold that cash on their balance sheet anymore, which they had been doing for the past couple of years. So that's leading to these corporate reforms where they're really like hand and fist returning cash to shareholders, right? In terms of buybacks, in terms of dividends. You're seeing a lot of corporate reform in Japan over the past couple of years. I think buybacks are up something like 85% year to date. So just really good fundamental momentum there. And again, just a good portfolio diversifier in terms of relative to the U.S. as well.
Certainly. Definitely worth exploring and considering. I think just kind of summing up the three key points, right? The United States, starting from a position of strength. Yes, there are headwinds mounting related to things like tariffs, but especially when you consider offsets like artificial intelligence and the U.S. leadership there, we do think that that market still has room to run over the course of the next 12 months. For Europe and Japan, it is worth calling out and emphasizing that you're seeing a big kind of pivot point, right? In the case of Europe, it's this departure from the long-held frugality that dominated the post-global financial crisis era. And in Japan, it is that sort of restoration of economic growth and inflation, which for that country is a good thing, and also this revisitation of more shareholder-friendly practices. I think especially as investors kind of wake up to the reality that there are opportunities to be found outside of the U.S., I personally have been hearing more questions about emerging markets. So any quick comments that you want to make there in terms of how we're thinking about that part of the equity landscape?
So it's nuanced. I think the reason you're probably hearing more about it is because of the U.S. dollar depreciation. And historically, when you think about emerging markets, they tend to do better in a depreciating dollar environment. Mm-hmm. That being said, you kind of need this like reigniting of global growth to really see that trade work. So just thinking about the nuances, I think obviously China, given it's such a large market cap in terms of emerging markets, there are some positives and negatives, right? So, the actual tariff exposure for that market is de minimis. It's like 2 to 3% of revenues are coming from U.S. exports. So that's not really the issue. The issue is the knock-on effects that may occur in terms of consumption that would then hit the broader economy in there, which is already really struggling, that would then hit the company fundamentals. But that's not to dismiss the fact that they're really going through an AI revolution at the same time. Mm-hmm. So the large cap tech companies stand out to us in terms of China. And then the other region I would point out that we're more positive on would be India, right? There's more of a domestic story, so similar to what we just talked about with Europe and Japan, where you have an easing both on the fiscal and monetary policy standpoint, so tax cuts, rate cuts, and you've seen negative earnings revisions for the past 8 to 9 months, and we think we're through the worst of that, really. So that's something that we think is more, and you can think of that as more of a more defensive emerging market. So we do like to take advantage of getting exposure to there.
Yeah, and what I think is one of the most interesting or compelling things about India, we wrote about this in our year ahead outlook earlier this year, it's that their earnings growth is actually pretty closely tied to their economic growth, which seems like it should be obvious, right? But it's relatively unique amongst those emerging market peers. As you took us around the world, you kept on touching on a handful of different themes, like calling out artificial intelligence, security spending that's really been kind of focused in Europe. I would love to start exploring some of those and thinking through the different trends and dynamics that bolster the conviction you have as an equity strategist in specific sectors.
So I think when we're thinking about investing through cycles and through volatility, thematics really stand out as something that makes it through different cycles, right? So that's kind of why we like to focus on that. And so to your point, the three that we'll focus on: AI, deregulation, which we haven't actually talked about and then also defense and security broadly. And AI, so what I was mentioning in terms of earnings, coming into the year and really starting in February, AI was what everyone was talking about at the end of the year, but then it kind of just fell off a cliff and nobody was talking about it. And then we got really solid earnings reports from, the Mag 7 and the like. And I mean, they beat by 28% in terms of earnings. Phenomenal. That's the best beat rate since Q4 of 2023, I believe. Really, really impressive. And they continue to show commitment to their spending, right? They're continuing to spend on AI. They continue to believe that demand is outstripping supply. And what you're seeing is as the cost of this technology continues to come down, the use cases broaden across, the economy, different types of companies, different sectors. And so you're really starting to see that come to fruition. Last year, 5% of corporates were using AI. Now that's closer to 9 to 10%. So still really low in terms of total adoption, but really quick move in terms of a doubling of that adoption. And I would say our bull case, which, has us close to 7,000 in the middle of next year, is really predicated on AI and this broadening use case where you see margins expand because you're able to grow your company at the same clip, but you can reduce headcount at the same time. You're seeing Google do that. You're seeing Amazon doing that. We talked about that at our Investor Day. It's really, prolific.
Well, and notably, the kinds of businesses that you just called out are those that tend to be in these knowledge industries that are also the real big first movers and adopters of the technology. And with labor costs representing such a large share of their total, to your point, that's really meaningful from a margin story.
Yes, absolutely. And then the other one, the second one that we mentioned, is around deregulation, which is really deregulation and deal making, I would say, are kind of intertwined. And that really focuses, I would say, on the financial sector, the banking industry. And that one's been a little bit slower to start the year, just given that there have been other policy initiatives. But you're starting to really see that momentum pick up. We're starting to see more IPOs. You're starting to see more capital markets activity really just over the past couple of weeks. And we got a new vice chair of supervision who's really talked about the need for deregulation as it relates to the large cap banks, which really, why does that matter? I mean, that matters because it opens up the ability for larger banks to lend to the economy so that they can grow, they can return cash to shareholders, whatever. They have $200 billion in excess capital on their balance sheets that they can then have more options with what to do with it. So that's a important theme.
Well, and like not only can it maybe be supportive for the cyclicality story of the economy, but they could also use that money to go out and do things like increase dividends or pursue share buybacks, which we've seen a few of the banks do so far year to date.
Well, and also take the baton from the government and the federal, like in terms of spending, right? If you look at what's happened post the global financial crisis, it's been that federal outlays have increased and banks have retrenched because of regulatory reasons. So taking that baton in that sense. And then the last one, which we've already kind of spoken about, was really around security. And I wouldn't say it's just defense. It's really like energy security, cyber security. If we're thinking about AI changes every day. So these cybersecurity firms are like constantly trying to figure out how I can, how nimble I need to be in terms of keeping my clients safe. And so that's just something that we really think has legs, even outside of what's been going on over the past couple of days. That's been a trend that we've been interested in over the past couple of years.
Beautiful. So if we're taking those themes and mapping them to sectors, I'm going to do my best. What I'm hearing is, as it relates to AI, maybe tech, or what I would constitute as tech plus, especially emphasizing the software sort of subsector. But we shouldn't sleep on opportunities as this proliferates and kind of starts to reach other sectors. One of those very well could be financials, where we also see tailwinds emanating from prospects for more deregulation over the course of the next few years. And then when it comes to playing security, like, what are you thinking? Industrials, which I know has already run really hard.
Yeah, that's the thing. Industrials has gotten, as a broad sector, gotten pretty expensive. It's the best performing sector year to date. It's trading north of 23 times. I think that would surprise a lot of people. And there's a lot of things going on. You've got defense contractors, you've got a lot of the more industrial complexes. So we really, really want to recommend it. It's just the valuation makes us a little bit hesitant. But I think having an active management approach to that sector is probably the best bet in terms of thinking about that exposure and being really focused on having a valuation lens as well.
Understood. And of course, when we say recommend, we mean publish a constructive view, so to speak, and insinuate the potential for outperformance. But look, everything you just walked through, it excited me. I am left feeling pretty bullish, but this definitely does not feel like a rising tide lifting all boats sort of environment, especially given all of those sources of uncertainty that we were talking about before. So as you sort of scan equity markets right now, what are the areas that you think could potentially underperform?
Well, so if you look at markets year to date, there are two sectors underperforming the broad market. It's consumer discretionary and healthcare.
Yeah.
I'm going to start with healthcare right now, but this could go on for a very long time in terms of the headwinds that are outstanding, two of which are happening really in real time today. It's the worst performing sector because of what's going on with the tax bill, taking kind of a chopping block to Medicaid spending. Then you have the administration talking about drug pricing reform, where they're going to really go after in terms of pharmaceutical companies. And then you add on top of that there's these impending sector tariffs because we have, national security interests in terms of so there's a lot going on where it's we get a ton of questions look, the valuation finally looks really attractive. It's one of the only sectors that's trading at a discount relative to its average. Why can't we think about, getting invested at the moment? And the problem is okay, if you have all of these outstanding problems from a policy or overhangs from a policy standpoint, how do you haircut earnings correctly to really get your head around what the right valuation is? And so it just becomes a very, very difficult exercise. So really not positive on healthcare in the near term, unfortunately.
All right. Well, I'll take one. I think what's interesting or maybe counterintuitive about that is that healthcare is one of the sectors of the S&P 500 that's supposed to be defensive, right? And in an environment where macro risks are elevated, I'm kind of taken aback as an investor. So if I am looking for other exposures that maybe can give me that equity allocation, perhaps with a little less volatility or some more defensive characteristics, where would you guide me towards?
I think there are a couple of options that stand out. So anything trading, you can think about dividend growth, dividend yielding types of companies tend to be a bit more defensive, particularly on the dividend growth, right? Because they've shown that they can continue to be profitable and continue to grow their dividends and pay them out to investors. Secondarily, I would say from a sector standpoint, we continue to still really like utilities. It's performed really well year to date, despite like a high interest rate environment, which you wouldn't think. But it's still trading at a pretty steep discount to the market. It's, 18 and a half times. And then on top of that, historically, the sector's grown earnings around 5%. But you add in kind of this AI infrastructure, AI energy demand that's really causing an uptick in terms of growth, and you could really see that earnings growth accelerate from 5% to 8% for the sector.
Sure.
So I think that's a more attractive defensive sector relative to, say, healthcare that trades at obviously a discount, or staples that trades at a premium to the market.
Well, and I love the point about utilities, like defensive sector with a growth story. That's pretty cool. And I think more broadly, as investors think through ways to enhance their portfolio resilience, you can, of course, do that within your equity allocation by balancing out different factors or styles and relying on something like dividends. But you also want to think through opportunities in other asset classes. Of course, there's the conventional approach that ballasts your equity allocation with something like core bonds, where we do have more conviction, I think, in munis right now versus something like treasuries. Or we've heard a lot of investor interest in other alternative sort of like safe haven type assets, like gold, for example, which has performed very well year to date on the wings of not just concerns around geopolitical conflicts, but also the kind of behavior you're seeing from central banks, and them continuing to buy the commodity in size as a means of diversifying their own reserves. So lots to do, lots of plenty and like compelling opportunities. Before we turn it over to Andrea to help us understand how we can actually tie this to action, just like 20-second high-level key takeaway about navigating the equity market in 2025, and then I'll let you off the hook till Q&A.
Well, I think it's important to remember that we've seen a much more volatile year this year than we did relative to last year, and that's probably going to continue, right? We're still working through tariffs, we're working through the reconciliation bill, but having a steady hand in terms of what you're thinking about being diversified, whether that's within equities or across your portfolio in terms of asset classes, I think is going to be very important as we head through the next couple of months.
Well, and while past performance doesn't indicate future results, the lesson we have learned from history time and time again is that one of the key ingredients to success when it comes to investing is simply time in the market and putting that money to work, doing so in a prudent, diversified way. Obviously, we have lots of opportunities to do so and ways that we can dial up or dial down exposures based on conviction. So thank you so much for sharing that with us. And now, Andrea, I'm so excited for you to come in and kind of help us bring this to life by demonstrating some of the features on our self-directed investing platform.
First of all, thank you for the awesome insights. Every time I hear you guys speak, I'm like, maybe I should rethink something in my portfolio. You know, lots of tidbits. Hopefully it's really inspiring others to kind of think a bit more about how they're invested in the choices they're making. Before I jump in and give everyone an express guided tour of the mobile app experience, I just wanted to acknowledge thank you to all of our self-directed clients. We really appreciate your business. We value you. Hopefully you're enjoying the evolution. We're constantly innovating. The app is going to keep getting better and better every day. And it's all for you. It's to serve more of your needs. So we're super excited about that. All right, so mobile, let's jump in. Okay, so I'm excited to introduce you to our mobile experience. This is our native mobile experience, where you can see JP Morgan's analyst focus list at the top. We're grouping different asset classes together by category, allowing you to think about how to invest in dividend-paying stocks and evaluate different criteria. We're also allowing you to sort through different names that have high dividend-paying yields. And so this is kind of an experience that's engaging you. It's bringing you in. Here you are looking at a name. You want to see what's happened to the price. Let's look at different time periods. Let's think about the context of the things you've heard today and where that could drive this individual name. You also have access to third-party analyst ratings as well as JP Morgan's. You can see news that's relevant. You can see where it falls within the current historical band, and then how persistent the dividend history has been for a particular name. So use the tools to be able to stay invested and be a more confident investor. The star at the top that you see, you can add this name to your watch list if you're not quite ready to invest now. Another awesome feature is you can hit the bell icon and set a market alert. You can set different kind of targets, whether it's prices down or it's hit a 52-week high or low. Just because life does get busy and you may want to get pulled back into the experience and be reminded of the thing that you had on your watch list that you may want to take action on. All right, so let's take a pause for a second. That's the mobile app experience around all of our different things on equities, but it doesn't stop there. So let's play a little bit further. Let's go back. So you can see the top navigation. We have multiple asset classes in the Explore experience. Stocks, ETFs, mutual funds, and then bond CDs and more. So you can see cross asset class, different opportunities. Even at the top, our new exclusive premium deposit product. We're also showing you fixed income and treasury products by yield, by maturity. So everybody thinks about this a little bit differently. We also have access to great money market funds. And so we're excited about what this can offer you. It can make you a more confident and thoughtful investor and give you tools to make great decisions. All right, so not everybody only lives in the Chase mobile app. You also sometimes go to your desktop and log into chase.com. And so let me give you a little bit more on maybe how you could play into Abby's ideas around financials. So let's set our own screen, a custom screen. You can go in on the left rail. You can show more of what industries you may want to select. Financial services is one that might be of interest. And you have a preference for mega cap today. This will result 22 different results. Great. Now you need to figure out what you're going to choose from there. We have lots of data points that are relevant to that asset class that can help you can sort and filter, thinking about price earnings, which maybe is something that you want to think through. And then you want to dig a little bit further before you're ready to invest. There's great utility within the quote experience. So drilling into any one name, again, plays you back. You're allowed to interact with the graph. You can play out different time periods, as you saw, same as mobile. So very familiar experience across web and mobile. We also have a great feature that allows you to see ways to invest in this name that are more diversified. So you can see this name held in ETFs and funds and the percentage weight that name is. And last but not least, the JP Morgan analyst rating. This is exclusive to our platform. You can see the investment thesis and the price and ratings targets and all of the details on how our analysts rate this company and what they do behind the scenes. And we're giving you that access. I know, it's a lot. And I could keep going on and on. There are so many tools that kind of can play into and bring that to life for our clients. So I challenge you to kind of poke around and make sure the things that you heard today, you're using the tools to help you be a great investor.
Well, I personally have poked around. I know how helpful they can be in sort of driving my own process as an investor. And I think serendipitously, we actually have a question as we transition to the Q&A portion of our session here that's going to parlay nicely into reiterating one of those key features. It's kind of for both of you, but Abby, someone is wondering if, especially given recent market volatility, if you would advocate for getting invested in one lump sum right now or considering more of a phase-in, or some people call it a dollar cost averaging approach. Any ideas there?
I think it's perfectly, so if we think about our embedded outlook, which we didn't really talk about like in detail, but we're expecting valuation compression from where we are. We're around 22 times today. We're expecting it to be between 20.5 to 21 times. So in our view, that would necessitate like, or be prudent to think about phasing in our view, right? Yeah. Just thinking about where we are, how quickly markets have run over the past couple of weeks. That's not to say that we don't think it's a great opportunity. We just think it's always prudent to dollar cost average over the next couple of months.
Yeah, and look, like you live in the 12 to 24 months sort of like outlook world. I personally try to take the bigger picture view of, okay, how are we going to help people pursue their financial goals and achieve them over time? And throughout history, like as I mentioned before, the most important thing is just to make sure you're getting that capital invested and putting it to work in the market. And what I find is that psychologically, a phase-in approach does help a lot of people. So I'm all for it. It's consistent with what you're saying. I would just encourage people to be really disciplined about it, because what you don't want is too much of a cash drag, especially if the market continues rallying. But phasing in can maybe help you kind of space it out and get you more comfortable with putting that capital to work. You can do that using a calendar-based approach, but you can also augment that by turning on something like that market alert feature that you walked through to tell me maybe when a specific security sold off 5 or 10%, so that I might be waking up to kind of the call to action to maybe accelerate some of that phase in. So.
Well, and I think just given how quickly markets have moved, like really in the past couple of years, like it feels like things, like last year we had 2 8% sell-offs. One recovered in 3 weeks, one recovered in 2 weeks. Like it's very, very quick. And so I think to your point, really having that push, because you're not going to want to do it when it feels really, really bad.
Yeah.
But that's usually the best time to do it.
Totally. Stay disciplined, come up with a plan.
The other thing that's great is being within the Chase mobile app. Money movement is quite easy, right? So on the Pay and Transfer tab, you have that prompt. You can come through and move money quite quickly into your SDI account and be ready to fund. And we also have great kind of short rate products that can give you access to cash quite quickly within the day's time. That might also be something to consider.
Well, that's a great segue to another question that we got submitted, which is, do we have ETFs and money market funds from institutions other than JP Morgan?
We sure do. It's a great question. It's actually a giant misconception. And so we are a full open architecture platform, which means we host both our funds as well as many others, some of the largest kind of brand name providers. So come and check it out.
Awesome. All right, shifting gears a little bit. Abby, I want to come back to you. Someone asked a very specific question about healthcare, which is how are you thinking about the potential of the GLP-1 weight loss drugs against sort of that broader macro perspective that you offered for the sector as a whole?
Well, I think that's a very unique and I would say targeted theme within healthcare. And by that, I mean there are very few companies that are actually executing on it. And so I do think it's a broad theme. And I do think actually what you're saying, I was just having this conversation about if you look at what's happening with food-related companies, they are, I mean, there's various reasons why they're under pressure at the moment, given what's going on with some of the health agency heads. But you're seeing them really, really take a hit in terms of what's going on in terms of consumption. So I do think, and I do think that specific therapeutic or medicine has the potential to really bend the cost curve as it relates to the healthcare industry generally, right? Because it's very preventative in nature, and so you could really avoid a lot of the costs that are associated with various illnesses, not just obesity and diabetes, but they're really doing, you know, work around various diseases, and so that could really be a game changer in terms of the cost of, you know, the U.S. healthcare system, which is north of $5 trillion today. So I think it could be game changing. It's just going to take a couple of years in terms of really building out the access for it.
There it is, that distinction between kind of the near-term headwinds that the sector is facing, but that long-term potential that a theme like the GLP-1s potentially presents. Okay, unfortunately, with an eye on the clock, we only have time for one more, but Andrea, I think this is a great one to kind of end on. So thinking through all of the tools that we have available on the self-directed investing platform, someone is wondering how they can sort of use the other features on our website to plan for longer time horizons and maybe those sorts of objectives that are 20 or even 30 years in the future. So how might you augment your use of the self-directed tools with other features on chase.com?
Yeah, I'd probably start with content, right? So educating yourself on retirement planning. There's a great retirement hub available on chase.com that can help you think through lots of different scenarios and calculators. We also have a wealth plan that allows you to set goals and think about more of the long term in terms of how do your portfolios ladder up to more of that planning and objective related investment thesis. So yeah, tons of tools, both from an investment product standpoint, but also tools to make sure that you're on track and doing the right things.
Perfect. Well, that is a great way to kind of bring this to a close. I think it's really important to acknowledge that whether you're choosing to invest on your own or you're seeking a partner to maybe help you build that wealth plan, JP Morgan is absolutely here to help. You can connect with one of our advisors, and you can also check out chase.com/theknow for those insights, or chase.com/SDI features to explore some of those tools that Andrea walked through today. Thank you both so much. I had a ton of fun walking through this with you. It's been a pleasure, and I really appreciate your time. And thank you all for joining.
If you are considering any investment or strategy, you should always do your research before making any investment decisions. Investment products are not bank deposit products, which means they are not guaranteed by a bank, not FDIC insured, and have risks, like the possibility of losing money on your investment. The S&P 500 index is an unmanaged, broad-based index that is used as representation of the U.S. stock market. It includes 500 widely held common stocks. Total return figures reflect the reinvestment of dividends. S&P 500 is a trademark of Standard & Poor's Corporation. The price of equity securities may rise or fall due to the changes in the broad market or changes in a company's financial condition, sometimes rapidly or unpredictably. Equity securities are subject to stock market risk, meaning that stock prices in general may decline over short or extended periods of time. Investments in commodities may have greater volatility than investments in traditional securities, particularly if the instruments involve leverage. Diversification and asset allocation does not ensure a profit or protect against a loss. JP Morgan Wealth Management is a business of JP Morgan Chase & Company, which offers investment products and services through JP Morgan Securities LLC, JPMS, a registered broker-dealer and investment advisor, member FINRA and SIPC. Insurance products are made available through Chase Insurance Agency Incorporated, CIA, a licensed insurance agency doing business as Chase Insurance Agency Services Incorporated in Florida. Certain custody and other services are provided by JP Morgan Chase Bank N.A., JPMCB. JPMS, CIA, and JPMCB are affiliated companies under the common control of JP Morgan Chase & Company. Products are not available in all states. Chase mobile app is available for select mobile devices. Enroll in Chase Online or on the Chase mobile app. Message and data rates may apply. Copyright 2025, JP Morgan Chase & Company. All rights reserved.